So I've actually got a postcode for Harrods now.
You told me you fucking know where it is.
This is like the 5th time we've gone around this roundabout,
I'm fucking driving. I told you to fucking just do the sat nav. It's not that fucking hard.
Magical.
Probably just going when all of your support levels break through.
When all your support levels break through, I'm probably just going to draw another one.
I think all the times in left.
You're going to negative.
Hi guys, so as you can see from the title of today's video, the topic of discussion is timeframes in Forex. Now, one of the questions that the Astro guys get on a daily basis is which timeframes you use to break down the market and which timeframes do you recommend using to actually trade from. Now, as you know, I'll actually head over to the guys now who are currently looking like they're breaking down the charts. As you know, it's Forex based, not really one of my specialities in Forex, so I'm gonna hand this one over to the Astro guys right now. So let me just pass you over and let's see what they're up to right now.
Right, so as Tori explained, a very, very important question and a popular question we get asked quite a lot, which is which timeframes are the most important in Forex trading? Now, there's different timeframes to, of course, monitor, analyze, and execute from. So I'm actually going to choose the higher time frames, so the weeklies and the dailies, and run through my opinions on both of them. So I do believe a lot of new traders will stay away from these higher time frames because they actually are in the misconception that that actually means slower profits and less profits, which is not the case. And I think as traders' journeys get on, possibly in that year 1 or year 2 period, then they realize, okay, I should have actually listened to these higher time frames to paint that picture for me. For example, the weekly time frame. Now, the weekly time frame, let's give you an example. If we have indecisive candlesticks on a weekly, particular 1 week, 2 week, 3 week, that's an important area of consolidation where we can actually go ahead and find that key level and help us draw those monthlies and those weekly key levels on. Then hopping to a daily time frame. Now we can actually see, is this daily candlestick going to cross over this key level? And many of the times we actually can get a rejection on that daily candlestick. So if that daily has crossed over, but before the day has closed, we've crossed back below that key level, that is going to give us a setup for a possible rejection. And of course, we can actually get the confirmed closes above the key levels to then obviously try and catch a breakout trade, for example. So I'm actually looking at a great example right now, which is the GBP USD, and I'm actually going to go ahead and highlight where I see, if this daily candle closes, where pound should be going for the following week. So this is a live chart of GBP USD. Now, as you can see, looking at a weekly time frame, we can help draw these key levels on that, of course, will help play a big part in where the market's going to go. And of course, I've managed to spot a major key level here at 1.4. Now, hopping to a daily time frame, this is a good example that's live right now. It looks like we are now crossing above 1.4. This is a major monthly key level in GBP USD. And as you can see in the past, that's the indecision I've been talking about, where the price cannot close above. And of course, during that day, it looked like it might have had the strength to cross over, but it did not. So this right now, as you can see, it's created a new high up here at 1.40800. Now, the price has come back below, and we still have quite a few hours to go before this daily candlestick's going to close. If this is closed, then we could potentially have a new bullish leg that could take us to possibly the recent highs back here, possibly up at 1.42500. But that's a great example of if this daily can hold its weight above 1.4, we could potentially be bullish. However, if this continues to fall back down, then this could be again another manipulation of 1.4, and we could then possibly create a nice bearish movement as well. So that's a good example of the weeklies and dailies in practice.
Hey guys, so as Nat was mentioning, monthly time frames, weekly time frames,
They are probably the most important, to be honest, to get the main key levels. Drawing the key levels on there, it really helps if you have structure. The key levels are more or less your foundations, and once you have those levels on there and you take into consideration quarter figures, 0 levels, i.e. psychological levels, and 50 levels, if you use them and utilize them properly from the higher time frames, the monthly and the weekly, it makes everything else, as you step down time frames in terms of your analytical methods, much more significant. And also you'll see how fundamentals, i.e. news releases, etc., central bank releases, you'll see those levels, the weeklies and monthlies, if you take into consideration the psychological aspect, 00s to 50s, etc., then you will find that most of the news pushes it to these major levels. What's good about that is that you can base trades from there. You can also base target projections from there as well, more importantly. Now, once you have that scope and you've broken that down and you understand why you put certain levels here, there, and you're always coming from the top down, I like to then look at 8-hour time frames, 4-hour time frames, mainly for execution. Why the 8-hourly? Well, last year I did a lot of traveling, and sometimes the daily time frame, as Nat mentioned, when the market is in a period of consolidation, even the daily can get a little bit of a mixed, you can get a mixed view from the daily. If the daily is very choppy, it's a little bit all over the place, you can then step down to the 8-hourly. 2 reasons. One, for that, so we then have free opportunities throughout the day to actually go in and look at certain candlestick patterns, certain reversals from those higher time frame levels, which I just mentioned, especially the psychological numbers. You can then, every single day, you have to have your tools correct. I mean, the GMT offset on your charts should be lined up for a daily closure at 10 p.m. London time. So if I'm using the 8-hourly, I can look at 10 p.m. I have 3 opportunities throughout the day, 10 p.m., then 6 a.m. in the morning, and so forth. I can wake up at 6:30, check how that 8-hour time frame, 8-hour candlestick close, and then more or less base decisions on that. Secondary to that, I use the 8-hour time frame when I'm traveling. So for instance, if I'm across the world, the time zones are different, i.e. let's say California, and the daily closure there, London time, is about 1 a.m. in the morning, 1:30 a.m. Now, most of the time while I was there, I wasn't really awake at those times, or I was doing something else where I wasn't really focused on the charts. And it makes it quite difficult to just follow that daily time frame. So again, utilizing the 8-hourly, wherever I am in the world, I can look at TradingView, I can look at the candlestick countdown, and then I can go in and have 3 opportunities throughout the day to actually base trades from. 4-hourly from there is quite something when it comes down to the, I wouldn't say more minor key levels, but I do draw key levels on the 4-hourly, and that's it. I would not go lower than the 4-hourly for my key levels as well. So in those choppy consolidation phases on the weekly time frame, maybe even on the week, on the daily, and on the monthly as well. So we have monthly, weekly, daily. If we are seeing choppy consolidation, I would recommend coming down to the 4-hourly, utilizing key levels on the 4-hour, not too many though, and keeping it in line with what we see on the higher time frame. So I wouldn't really step down lower than a 4-hour, to be honest. So take what Nat said into consideration, come down, maybe check out the 8-hour time frame for yourself, and also take that gem of ensuring your charts close for the day at 10 p.m. London time. And I do believe that's the FXCM data feed over here on TradingView as well, guys. So my tip, mine and Nat's tips combined, to sum it up, don't go lower than the 4-hour time frame for executions. And it also depends how much time you actually have in the day to look at your charts. So 8-hourly, if you're working let's say a 9 to 5, you do have the 8-hour time frame. You can come in 3 times a day, maybe once before work, once after work, and obviously the daily close there as well. So that's what I have to say on this topic for now, and I probably will expand on it in another video. Thank you.
So as an example, this is the GBP JPY daily time frame. We had consolidation here, and we finally broke into new lows, found support, reversed, came back up, and we have mixed signals going on. We have a bullish opportunity here when we break back above the MAs of support, and we also have a bearish example too. What we need to take into consideration are the key levels and the placement. Now I trust the placement of these key levels. However, 1 to 3 bearish days in the midst of this consolidation and messy phase can often trick people into going the opposite direction. As we can see, there's 1, 2, 3 wicks where the market is actually losing a lot of steam and momentum. Now, if you were to go long after this daily candlestick, which by judging from how it's actually ending up right now is probably not going to be a good move, you could get sucked into the wrong direction, i.e. same as this green candle here and here. How we can get around this is obviously stepping down to the 4 hourly, and what we can see is that the price action is actually suggesting from 145 on GJ, we're actually making discrete higher lows. 1, 2, both on support, and then today, early this morning, the 4-hour bar close straight off this blue area of support right here actually provided us with a decent opportunity to go long. So whereas on the 4-hourly we could have got in around 147.60 on that closure and caught the majority of this move to the upside, if you actually waited for the daily close, you would have missed that. Your risk reward would have been out of balance. And then again, as you can see here, we do have some resistance. I haven't actually drawn a line on yet, but this thing could actually start to roll over the opposite direction. So guys, if you are struggling with higher time frames, always look at the bigger picture, use the key levels that me and Nat just spoke about, and then come into the 4-hourly and keep it nice and clean and simple.
Now that's Sean and Nat's experience, having traded in this market now for about 8 or 9 years, and that's great. They've almost added their own personality to their trading. Now from my experience, having been involved now with Astro for about 2 or 3 years and having taught all over the world and in fact here, especially in the UK, a lot of it is how do you personally feel about the market? Are you a slightly more faster paced individual? Do you want to be involved in the market? And therefore you should probably be looking at lower time frames, whether that is focusing on maybe the 2-hour, 4-hour, those intraday setups that allow you to actually work alongside your personality. We will often find that students come in, they'll be quite young, they will often look for those type of sharp intraday setups because they're looking for faster money. Now those who understand money slightly better, maybe of an older generation and investing into housing or different types of bonds and assets, they will understand that the higher time frames gives a broader perspective and therefore that money doesn't come that quickly. So if we take a look here at Euro JPY, from my personal perspective, I like to trade quite aggressively. So I will whip down into lower time frames like I'm going to show you now. Now here on Neuro Jpy, what we can see is this 2-hour time frame. Now if we were trading during the Asian session as we opened up, we've dipped in and taken out the previous day's low. On here, if we were looking at much higher time frames, we could have missed out on a nice little 70, 80, 90 pip type move. What we can see is that we've taken out the previous day's lows and formed the correct type of price action to then go and formulate and spike and take out the previous day's high. Now for me, as slightly more of an aggressive trader, I'm throwing my personality into my trading and I'm looking at stealing those nice intraday pips between 100 and 150 pips per trade.
So guys, this is the bookshelf, and I know you've seen this in many of the videos now. It is currently under construction. We've managed to get a lot of it over with the original shipment of all our clothing and our items, etc. We do have around 100 collectively still to bring and hopefully fill out this entire bookshelf. So I feel like whilst we're here, why not at least give 3 of my favourite book recommendations for the time being? We don't actually have that many trading related books for the time being, so why not go for some of the more generic ones for the time being you can actually relate to personal life and your own trading journey. And I feel like to start this one off, let's go for The Alchemist. Alchemist, one of my personal favourites and one of the first books I ever actually read. The Alchemist is one of the best ways to relate to your own personal life and your own journey, whether that's in Forex, whether that's in your own work life. This is one of the best ways to actually motivate yourself and continue going in whatever career you're doing. One of the best things about The Alchemist is it also throws a bit of philosophy in there and lets you know maybe there is a higher being actually looking after you in your worst times. One of my favourite books, I would highly recommend this one. One of the other ones, which I guess you could say does actually relate to Forex and trading and cryptos and investing overall, is Rich Dad Poor Dad. One thing that really stuck with me in this book is the mindset of the 9-to-5 worker versus the entrepreneur. And it tells you about the spending habits, the investing habits, and the overall expenditure of a 9-to-5 worker versus an entrepreneur. And you'd be surprised how much it separates them from a regular person. To finish this one off, of course, you know I am the crypto guy, so it makes sense to finish off with a Bitcoin book. I've mentioned this on Instagram once, I let it slide. This is one of my personal favorite books and one of them that actually got me intrigued into cryptocurrencies. One of the biggest things that actually got me attached was the future of money. Got me thinking, can cryptocurrencies truly become the future of money? One thing as well, it actually is promised and quoted by Sir Richard Branson himself. That intrigued me. Maybe this is the future of cryptos. One thing I should mention is it will teach you about blockchains, about Bitcoin itself, and even give a bit of a conspiracy about Satoshi Nakamoto himself. So guys, one of my favorite books, highly recommend you read this one.